In this series, we'll cover all the major themes and tools that The Intelligent Investor by Benjamin Graham brings to the table. You'll learn the crucial difference between investing and speculating and why it matters for your portfolio's long-term health. We'll explore margin of safety, the central concept Graham says every investor must understand in order to protect capital. You'll discover how to handle market fluctuations by meeting the whimsical Mr. Market and learning to see price swings as opportunities rather than threats. Along the way, we'll explain the defensive versus enterprising investor approach and guide you on how to choose which style might fit your personality and goals. We'll dive into portfolio policies that address the balance of stocks and bonds, how to deal with the impact of inflation, and when to consider specialized securities like convertible issues or warrants. You'll see how to apply fundamental analysis to spot high-quality companies and avoid pitfalls, looking at a firm's balance sheet, per-share earnings, dividend policy, and even the behavior of its management team. You'll also learn how to deal with emotional discipline, which Graham warns is often more important than intelligence when navigating market cycles. Throughout this summary of the book, we'll highlight case studies that Graham uses to show how his principles work in real life. By listening to this summary, you'll gain practical, time-tested strategies for safeguarding your principal, spotting genuine bargains, and building a robust investment plan that can withstand volatile markets. Whether you're a complete beginner or a seasoned market veteran, these core lessons form the bedrock of intelligent, level-headed investing. Imagine having a roadmap that never goes out of date, a set of guidelines so solid that even decades later, it's still hailed by one of the world's most successful investors. That's precisely what you'll get from Benjamin Graham's insights, and it's why we're devoting this video to exploring the chapters of The Intelligent Investor. Warren Buffett himself called Graham's work the best book on investing ever written, and his own fortune stands as proof that these principles work when followed with discipline. You'll hear about how Graham's focus on intrinsic value and a margin of safety protects your money first, long before worrying about outsized returns. It's a mindset that flips Wall Street's usual get-rich-quick pitch on its head. By the end of this video, you'll grasp why it's crucial to separate genuine investing from speculation, how to keep emotions in check, and how to put safeguards in place that let you sleep at night, even when markets get choppy. Stick around, because these foundational ideas will not only help you invest smarter right now, but will also prepare you for the inevitable market highs and lows in the future. In other words, if you're looking for a practical, time-tested approach that has shaped everyone from Warren Buffett to countless other successful investors, this is where your journey begins. Chapter 1. Investment versus Speculation. In the first chapter of The Intelligent Investor, Benjamin Graham introduces one of the most fundamental distinctions in the world of finance: the difference between investing and speculating. This distinction is critical because it determines how individuals approach the stock market, manage risk, and build long-term wealth. Graham makes it clear that failing to understand the difference can lead to disastrous financial mistakes. The definition of investment. Graham defines an investment operation as one that, after thorough analysis, ensures the safety of principal and provides a satisfactory return. This definition is crucial because it sets clear requirements for what constitutes genuine investing. The two essential elements are: 1. Thorough analysis. Investors must study a company's fundamentals, including its financial health, competitive position, earnings history, and future prospects before making a decision. 2. Safety of principal and a satisfactory return. Investing should focus on protecting capital first and then seeking reasonable, sustainable gains over the long term. If an operation does not meet these criteria, Graham states that it is not an investment, it is speculation. What is speculation? Speculation, according to Graham, occurs when a person buys or sells a stock based primarily on expected short-term price movements, rather than the actual value of the underlying business. Speculators often make decisions based on market trends, predictions, or excitement, rather than detailed financial analysis. He acknowledges that speculation is not necessarily bad if it is done consciously and with discipline. However, it becomes dangerous when individuals believe they are investing when they are, in fact, speculating. This is particularly common in bull markets, when rising stock prices create the illusion that everyone is making smart investment decisions. In reality, many people are simply riding the wave of market enthusiasm without truly understanding the risks involved. Why the distinction matters. Graham warns that confusing speculation with investing can be extremely harmful, especially for inexperienced market participants. Many people enter the stock market seeking quick profits, assuming that rising prices reflect intelligent decision-making rather than sheer luck or temporary market conditions. This leads to overconfidence and excessive risk-taking. During strong bull markets, speculation appears to be highly rewarding, which encourages more people to engage in risky behavior. However, when the market eventually declines, speculators often suffer the most significant losses because they lack the fundamental safety net that disciplined investing provides. Graham's key message is that speculation should never be the foundation of a financial strategy. Investors should always separate their investment portfolio from any speculative activity, ensuring that the majority of their capital is allocated to fundamentally sound, long-term investments rather than short-term gambles. Market cycles and investor behavior. Graham highlights the cyclical nature of the stock market and explains that market fluctuations are inevitable. Investors who fail to distinguish between speculation and investment are more likely to suffer during downturns because they base their decisions on price trends rather than fundamental value. In rising markets, speculative enthusiasm leads to overvaluation, where stocks are bought at prices far above their intrinsic worth. When the bubble bursts, prices fall sharply, and those who speculated without considering intrinsic value often see their wealth evaporate. On the other hand, intelligent investors who base their decisions on solid fundamentals are less affected by these wild price swings because they purchase stocks at reasonable prices with a margin of safety. Graham stresses that an investor's success depends more on temperament than on intelligence. The ability to remain rational and disciplined during market extremes is far more valuable than any attempt to predict short-term market movements. Graham's practical advice for investors. To avoid the pitfalls of speculation, Graham offers several guiding principles. 1. Recognize whether you are investing or speculating. If you are making decisions based on a company's intrinsic value, you are investing. If you are buying stocks primarily because you believe their prices will rise in the short term, you are speculating. 2. If you speculate, do so consciously and cautiously. Graham does not entirely dismiss speculation, but advises keeping it separate from an investment portfolio. He suggests allocating only a small portion of capital to speculative ventures and never confusing them with long-term investments. 3. Focus on long-term value rather than short-term price movements. The stock market is highly volatile in the short run, but true investors concentrate on the long-term financial health of businesses rather than temporary price changes. 4. Avoid emotional investing. Market trends and media hype can mislead investors into making impulsive decisions. Graham emphasizes the importance of maintaining discipline and avoiding herd mentality. 5. Have realistic expectations. Many people enter the stock market expecting extraordinary gains, but Graham warns that investing should not be about making fast money. It should be about steady, sustainable wealth building. Chapter 1 of The Intelligent Investor lays the foundation for Graham's approach to investing. His central argument is that true investing requires a methodical, rational, and disciplined approach focused on preserving capital and generating reasonable returns. He urges readers to resist speculation and instead adopt the mindset of an intelligent investor who makes decisions based on careful analysis and long-term fundamentals rather than market hype or short-term price trends. This chapter serves as a powerful warning against the dangers of speculation and highlights the importance of maintaining a clear, disciplined investment strategy. By following Graham's principles, investors can protect themselves from unnecessary risks and position themselves for long-term financial success. Chapter 2. The Investor and Inflation. Benjamin Graham opens this chapter by stressing that inflation, defined as the persistent rise in the general level of prices, poses a real threat to all investors. Although inflation can fluctuate and sometimes remain low for years, Graham warns that it is a steady, long-term force that gradually reduces the purchasing power of money. Below are the core ideas he conveys. 1. Why inflation matters to investors. Graham points out that even mild but consistent inflation can quietly erode an investor's returns. If the rate of inflation averages, for example, 3% a year, then over 10 or 20 years, the actual purchasing power of one's saved capital diminishes much more than most people realize at first glance. This is especially significant for, first, bondholders or anyone on a fixed income. A fixed coupon or interest payment does not rise along with prices, so what starts out as a comfortable yield can gradually become insufficient to cover living expenses. Second, retirees, or those depending on stable payouts. Since their income is not adjustable, rising prices mean each dollar buys less over time. Graham notes that the threat of high inflation, sometimes described as creeping or persistent, had become a more accepted risk by his day than it had been for earlier generations who expected stable or even deflationary conditions. 2. No perfect hedge against inflation. One of Graham's central arguments is that no single investment is a guaranteed defense against ongoing price increases. While some might believe gold, real estate, or other hard assets can act as a direct hedge, Graham cautions that these too can become overvalued or face periods of stagnation. He similarly addresses the common belief that common stocks naturally outpace inflation, drawing on historical data to show that over long stretches, equities have tended to do better than fixed income instruments when prices are rising. Still, he emphasizes there is no certainty that stocks will keep up with every bout of inflation, especially if purchased at inflated prices. The actual companies behind those stocks must be fundamentally sound, and the investor must be mindful not to overpay. 3. The risks of overreacting. Graham acknowledges that fear of inflation might push some investors into drastic measures, such as investing heavily in speculative assets or constantly trying to shift their holdings. He warns that an overreaction can be as dangerous as ignoring inflation entirely. For instance, jumping into commodities or other hot hedges without proper analysis can amount to speculation, a theme he introduced in Chapter 1. He advises a level-headed approach. First, recognize that inflation is likely to persist in one form or another. Second, accept that there is no bulletproof solution. Third, invest with a margin of safety, which means not overpaying for stocks or long-term bonds. 4. Balancing stocks and bonds in light of inflation. Since Graham wrote in a period when high-grade bonds were popular and stocks were sometimes viewed warily, he devotes attention to whether fixed income securities remain worthwhile. His nuanced stance is that bonds can still serve a purpose, particularly for defensive investors who want predictable income, but one should be realistic about their vulnerability to rising prices. Meanwhile, equities offer potential growth that can offset inflation, but they also introduce market volatility. For Graham, the question is not stocks versus bonds in an absolute sense. It's finding the right balance and investing in each carefully. First, defensive or conservative investors may still hold a portion in bonds for stability, but should consider having some stock exposure to guard against inflation's long-term erosive effect. Second, more enterprising or aggressive investors might tilt a larger share towards stocks, provided they select them via thorough analysis and reasonable valuations. 5. long-term perspective, and prudent allocation. Above all, Graham's guidance in Chapter 2 is to stay calm, rational, and diversified. He does not advocate abandoning bonds entirely, nor does he advocate piling into equities blindly. Instead, he reiterates that the intelligent investor recognizes inflation as a reality and positions the portfolio to endure it without succumbing to frantic trading or speculation. Over time, prudent asset allocation and disciplined stock selection, supported by careful analysis, can mitigate inflation's impact. Key takeaways. Inflation erodes purchasing power and thus lowers real returns, especially on fixed income investments. No single asset class, stocks, bonds, or hard assets, provides a foolproof defense against rising prices. Common stocks can offer a partial hedge, but only if purchased at reasonable valuations and after solid analysis. Balancing bonds and stocks in a portfolio is still essential. Neither should be discarded outright, and the allocation depends on one's financial goals and risk tolerance. Avoid extreme, panic-driven measures. Overreacting to fears of inflation can lead to speculative and undisciplined choices. In summary, Chapter 2 emphasizes that inflation is a permanent factor in modern economies, one that all investors must plan for. Rather than searching for a magical safeguard, Graham advises acceptance, caution, and diversification, all anchored by the principle that careful analysis and clear thinking will serve an investor better than speculative fads in any economic environment. Chapter 3 of The Intelligent Investor, titled A Century of Stock Market History, The Level of Stock Prices in Early 1972, provides a historical overview of stock market fluctuations from the late 19th century through Graham's present day, illustrating the recurring booms and busts that investors must navigate. Graham's goal is to show how past experience can guide the intelligent investor in assessing whether the market is over or undervalued at any given time. 1. Overview of long-term market trends. Graham begins by reviewing key phases of the U.S. stock market over approximately a century, dating back to the 1870s. He points out that while the market's overall trajectory is upward in the long run, periodic depressions and panics such as those in 1907, 1929 to 1932, and 1937 to 1938 reveal a cyclical nature. Major bear markets can erase vast gains quickly, and bull markets sometimes drive prices well above rational valuations. A note on Dow Jones Industrial Average. Much of Graham's discussion references the Dow Jones Industrial Average, DJIA, because it is a widely recognized barometer of stock price movements. He outlines how the DJIA grew, and occasionally shrank, during distinct bull and bear cycles, underscoring that prices can run far ahead of true economic growth in euphoric periods, only to tumble drastically in more pessimistic times. 2. Boom and bust cycles and their lessons. Graham identifies notable periods of market optimism and collapse, using them to highlight investor psychology and how it changes. Pre-1929 boom and the 1929 crash. He reminds readers that the roaring bull market of the late 1920s seduced many into believing stock prices would only continue rising. The subsequent 1929 crash and the Great Depression offered a sobering lesson. Prices can plummet with shocking speed when expectations become unmoored from business fundamentals. 1949 to 1968 bull market. After World War II, especially starting in 1949, the market undertook another extended upswing. This bull phase, which lasted into the 1960s, led many to assume that stocks were a surefire path to prosperity. But Graham notes that no bull run is permanent, and by the late 1960s and early 1970s, the market began to show signs of strain. 1969 to 1970 decline. This relatively sharp decline, coming on the heels of a prolonged bull market, once again reminded investors that reversion to more modest valuations is an inevitable part of market history. Graham urges readers to keep past declines in mind to avoid being caught off guard when euphoria evaporates. In describing these cycles, Graham underscores a central theme. Stock prices are neither static nor predictable, and each new generation of investors often repeats the emotional mistakes of its predecessors. 3. Measuring the market's right level. A recurring question then and now is whether there exists a formula or signal that can tell investors if the market is too high or too low at any given moment. Graham is cautious in his assessment. He believes certain yardsticks such as price-to-earnings ratios, dividend yields, and corporate earnings growth can offer insights into whether the market as a whole might be overpriced or underpriced. However, he argues there is no foolproof method of divining an exact, fair value for the entire market. Investors who look for a perfect market timing formula are likely to be disappointed. Graham advises that historical data, while helpful for perspective, cannot definitively forecast future price levels. Nonetheless, investors who understand past swings have a better chance of staying realistic during present-day peaks or troughs. 4. Context. Early 1972. Because Graham was writing in the early 1970s, he offers his assessment of that period's market conditions. He notes that the substantial run-up of stock prices in the 1960s, coupled with the slowdown that began around 1969 to 1970, raised questions about whether stocks were fairly valued. While he doesn't offer a definitive prediction, he suggests caution in assuming that the market would immediately resume its earlier meteoric growth. Instead, he encourages readers to check whether valuations are consistent with actual corporate earnings and prospects. 5. Implications for the intelligent investor. From this long review of market history, Graham draws a few key lessons for anyone looking to invest intelligently. 1. Market history rhymes. Although each era has unique features, human nature in financial markets tends to repeat its cycles of over-optimism and over-pessimism. Recognizing this pattern can help investors avoid chasing euphoria at market tops or surrendering to despair at market bottoms. 2. No guaranteed timing tool. Graham reiterates that trying to time the exact top or bottom of a cycle is inherently risky, often leading to speculative mistakes. Instead, he suggests a focus on individual company fundamentals and a reasonable asset allocation strategy. 3. Valuation matters. Even in a seemingly unstoppable bull market, buying stocks at inflated prices can backfire badly. A long view of history reminds us that stocks revert toward more sustainable valuations over time. 4. Temperament is key. Knowledge of market history should serve to bolster an investor's emotional fortitude. Rather than simply following the crowd in euphoric or gloomy times, the intelligent investor uses historical context to remain prudent and rational in decision-making. In Chapter 3, Graham's review of a century of market fluctuations is not mere nostalgia. It's meant to instill humility and perspective in the reader. He warns that neither past performance nor statistical averages can perfectly predict future outcomes, but they can help investors ground their judgments. By understanding how drastically and how often markets swing, one can learn to navigate new cycles with greater clarity. Maintaining a commitment to fundamental analysis and a margin of safety, no matter how tempting or frightening the current climate may be. In our next video, we'll cover Benjamin Graham's guidelines for the defensive investor, someone who wants minimal effort, lower risk, and steady returns. We'll explore how to structure a balanced portfolio of stocks and bonds, as well as Graham's criteria for selecting stable, long-term stocks. It's a perfect introduction for those looking to protect principal first and grow at a steady, sensible pace. So be sure to tune in for a clear roadmap to a conservative investment strategy based on time-tested principles that have guided generations of steady, successful investors.